Have you ever felt the subtle weight of uncertainty in your investment journey? Acquired unease that perhaps the common narratives, the very bedrock of conventional financial wisdom, might not be serving you as faithfully as promised. Perhaps you've wrestled with the sheer volume of conflicting market information, a chorus of voices offering expert advice, often leaving you more lost than found amidst the noise. The quiet fear of making a costly mistake, a misstep that could jeopardize the future you're diligently building, is a heavy burden to carry. It's a feeling of being adrift, striving for financial mastery, yet often questioning the compass you've been given. This deep-seated frustration, this fear of being outmaneuvered by forces you don't fully comprehend, is a common current running beneath the surface of many ambitious investors. It speaks to a profound truth that Benjamin Graham, the sagacious father of value investing, articulated so clearly. The investor's chief problem, and even his worst enemy, is likely to be himself. He understood that the greatest saboteurs of wealth are often not market crashes or economic downturns, but the very beliefs we hold, the silent fears of financial loss and investment inadequacy that drive us to cling to damaging myths. These aren't just minor miscalculations. They are deeply ingrained misconceptions, insidious whispers that, left unchallenged, are subtly but surely diminishing your potential for sustainable wealth. They erode not just your capital, but your confidence, leaving you feeling uncertain about how to truly build lasting value. Today, we walk into the heart of that uncertainty, not to condemn it, but to understand it, to embrace the discomfort of questioning what we thought we knew. This space is not about chasing fleeting trends or get-rich-quick schemes. This is about deep understanding, about peeling back the layers of market noise to reveal the data-driven truths that empower genuine financial independence. We seek to understand the *Y* behind every decision, to forge a path built not on dogma, but on the bedrock of critical analysis and time-tested principles. We are uncovering the hidden truths behind wealth accumulation, truths that often lie beyond the headlines, waiting for a discerning eye to find them. Don't just invest, understand the why behind every decision. We invite you to cultivate a questioning mindset, to challenge the consensus, and to find your unique edge in a world often swayed by emotion rather than logic, ensuring your path to financial freedom is built on understanding, not on myth. It is a commitment to transforming those feelings of being outmaneuvered into empowered, independent decision-making. Have you ever felt that silent dread creep in when the market falters, despite believing your portfolio was diversified? That gnawing question, a whisper of inadequacy, asking why broad market indices can still drag your seemingly protected assets downwards. It's a profound frustration, a feeling of paralysis when conflicting data suggests that the very bedrock of conventional wisdom, the idea that simply owning more assets automatically reduces risk, might be a delusion. This common distortion, often leading to what Warren Buffett's partner Charlie Munger termed diversification, is a myth that subtly erodes true wealth protection. The conventional wisdom suggests that simply spreading your investments across many different companies, sectors, or even asset classes, regardless of their underlying quality or true purpose, automatically ensures safety. Yet, during systemic crises, the shattered expectation often reveals a counterintuitive truth. Seemingly diverse assets often begin to correlate, moving in lockstep, exposing investors to hidden concentrations and uncompensated risks overlooked by mainstream analysis. It's like believing you're safe from a storm by standing under many small, leaky umbrellas, only to find they all fail at once under a true downpour. So, how do we transcend this delusion and build genuine resilience? We turn to an intelligent diversification technique rooted in the principles of strategic capital allocation. First, truly understand asset correlation through rigorous quantitative analysis, not just superficial categories. What assets genuinely move independently? Second, identify concentrated value with a robust margin of safety framework, as Benjamin Graham taught. This means owning businesses whose intrinsic value far exceeds their market price, providing a cushion against unforeseen events. Third, stress test your portfolio construction against historical market shocks, asking how would these assets have performed during the deepest recessions or inflationary spirals. Think of it like an architect building a robust structure. True portfolio security comes not from adding more rooms haphazardly, but from reinforcing the foundation and ensuring each structural element serves a distinct, value-additive purpose. It's about intentionality, about understanding the true nature of your holdings rather than simply accumulating them. Is your diversified portfolio truly diversified, or is it merely a collection of assets that will betray you when you need them most? Have you ever felt the sharp sting of frustration watching an obvious market opportunity slip through your grasp, or perhaps clung to a losing position far longer than wisdom advised? It's a disquieting feeling, isn't it, to believe in rational decisions yet find yourself a perpetual follower, swept along by currents you don't fully control. This experience can leave a philosophical wound, questioning the very fairness of the market itself. At the the heart of this struggle lies a common distortion of the efficient market hypothesis. This myth suggests that market prices always perfectly reflect all available information, making it impossible for any investor to consistently find undervalued assets or outperform the market. This belief, left unchallenged, subtly disincentivizes the deep analysis and critical thought that are the hallmarks of true investing, lulling many into a passive acceptance of whatever the market offers. Yet, behavioral finance reveals a shattered expectation, a hidden truth. Markets are far from perfectly efficient. They are, in fact, often profoundly inefficient, precisely because they are populated by human beings, susceptible to widespread and unconscious cognitive biases, anchoring to past prices, succumbing to herd mentality, or the powerful grip of loss aversion. These emotional currents create predictable waves of irrationality, waves upon which a disciplined, data-driven investor can find profound opportunities. To navigate these treacherous waters, we can forge a mental healing model, drawing wisdom from Daniel Kahneman's Thinking Fast and Slow and Benjamin Graham's The Intelligent Investor *. Kahneman's work illuminates our system one emotional, intuitive reactions to market noise, often leading us astray. Graham, meanwhile, provides the system to analytical rigor and independent thought, a practical framework to identify and neutralize those impulsive emotional responses. It's about cultivating the discipline to pause, to question, and to apply fundamental analysis even when the crowd is roaring in another direction. The market, much like the mythological sirens, often lures investors with intoxicating emotional narratives and the promise of short-term trends. But the wise investor, like Odysseus, must consciously tie himself to the mast of intrinsic value and data-driven conviction. This allows us to navigate away from psychological traps, to hear the alluring songs without being swayed, and to steer our course towards sustainable wealth, guided by an unwavering commitment to truth. What narratives are you allowing to steer your ship? Have you ever carried the unconscious limiting belief that significant wealth can somehow be generated without sustained, intelligent effort? It's a quiet yearning, isn't it, for easy money or truly passive schemes, a hope that often leaves us feeling profoundly betrayed when promised returns evaporate or hidden complexities emerge, eroding not just our capital but our sense of agency. This pursuit of the effortlessly abundant, the set it and forget it dream, is a widespread myth that subtly undermines genuine wealth creation. The distortion lies in the belief that certain investments, be they high dividend stocks, rates, covered calls, or even some digital assets, are inherently passive and therefore require no ongoing due diligence, no active risk management, and no deep understanding of their underlying mechanics. This misconception, often fueled by marketing narratives, overlooks a critical truth. Nothing truly valuable in the financial world is entirely passive. Every stream of income, every asset, demands a vigilant eye and an informed mind. The systemic risk often overlooked by mainstream analysis is that many of these seemingly passive income streams actually demand significant active management. They often come laden with hidden fees that silently erode returns, expose investors to concentrated, uncompensated risks, or are simply a sophisticated repackaging of principle, slowly returning your own money rather than generating true, sustainable profit. It's like believing a river will flow endlessly without a source, only to find its waters diminishing over time, leaving you with less than you started. To truly understand these streams, we must adopt a forensic accounting approach. This means meticulously calculating the true yield after all fees and taxes, assessing the underlying asset's quality and the sustainability of its income generation, and rigorously stress testing it for liquidity and resilience during market downturns. Only by peeling back these layers can we reveal the true cost of convenience and distinguish genuine value from clever illusion. Ray Dalio reminds us that understanding the underlying mechanisms, the hidden truths, is paramount. Chasing truly passive income without this critical analysis is akin to planting seeds in barren soil and expecting a perpetual harvest. Sustainable wealth, much like a thriving garden, grows not from magical thinking, but from diligent cultivation, from understanding the true nature of the ground, and from strategic capital allocation. Are your passive income streams truly feeding your wealth, or are they silently siphoning it away, disguised as effortless gain? Have you ever felt that unsettling feeling of inadequacy, of being outmaneuvered in the competitive financial landscape, doubting your own ability to truly make informed, independent investment decisions about the cyclical nature of markets? It can lead to a profound sense of powerlessness, a quiet surrender to forces that seem beyond your control, leaving you to merely react rather than proactively shape your financial destiny. This feeling is often reinforced by a common distortion, almost a dogma, that market timing is impossible. This belief, deeply ingrained in conventional wisdom, leads to a fatalistic acceptance of broad market movements, disincentivizing deep analysis and encouraging a passive approach often rationalized by simplistic advantage. advice like time in the market, not timing the market. While the latter holds truth, it often overshadows the power of strategic positioning. But what if the impossibility isn't in timing the market precisely, but in failing to position strategically? The story of George Soros and his reflexivity theory reveals a critical truth. While predicting the exact peak or trough is indeed elusive, strategic positioning based on rigorous macroeconomic analysis and an understanding of behavioral anomalies is a learnable skill, not mere speculation. Soros understood that market prices don't just reflect fundamentals, they also influence them, creating feedback loops that astute observers can anticipate and capitalize on. To cultivate this data-driven edge, we can embrace a three-step macroeconomic analysis technique rooted in fundamental principles. First, discern genuine economic cycles and sentiment shifts by analyzing leading indicators, those subtle harbingers of future economic activity. Second, meticulously track capital flows, observing where money is moving globally, identifying areas of both opportunity and risk. Third, understand credit cycles, the ebb and flow of lending and borrowing, which often precede significant market shifts. Distinguishing these from mere market noise enables truly informed capital allocation. The financial market, in its profound complexity, is not a random walk, but a dynamic ecosystem with discernible seasons. The wise investor doesn't possess a crystal ball to predict the exact date of spring's arrival, but rather understands the subtle signs of winter's end and positions their portfolio with strategic foresight for the coming growth. Are you merely enduring the market's seasons, or are you learning to read their signs and position your wealth with intentionality? Have you ever felt a deep sense of betrayal, a quiet frustration, when the conventional financial advice you trusted failed to deliver? When conflicting information from so-called gurus left you more confused than enlightened, eroding your faith and leaving your financial confidence wounded? It's a profound pain, feeling that your desire for mastery is sabotaged by the very sources meant to guide you. This struggle often stems from a common distortion, the belief that financial expertise resides solely with credentialed gurus, charismatic media pundits, or large, seemingly infallible institutions. This myth encourages investors to outsource their critical thinking and surrender their decision-making autonomy, believing wisdom only flows from an anointed few. It's a dangerous path, disconnecting you from the data and analysis that empower true understanding. The hidden truth here lies in an unconscious cognitive bias known as authority bias. This powerful psychological pull can lead us to accept expert opinions without rigorous scrutiny, even when verifiable data or our own intuition contradicts their narrative. This blind trust, this surrender of personal financial mastery, can lead to chronic market underperformance, leaving you feeling perpetually behind, wondering why your diligent efforts aren't yielding the anticipated fruit. It's a quiet form of self-sabotage. To heal this wound and reclaim your financial autonomy, we need a practical framework for developing a truly independent critical financial mindset. This begins by evaluating all financial advice not on the charisma or reputation of its source, but on three pillars. First, transparently understanding the incentives of the advisor or institution. Second, demanding data transparency and rigorous quantitative analysis to support any claims. And third, ensuring that the advice aligns precisely with your long-term wealth goals and personal values. It is about becoming your own deepest authority, guided by reason and verifiable truth. Relying solely on a financial guru, no matter how esteemed, is like attempting to navigate a complex maze by simply following someone else's footsteps. True mastery, true financial independence, comes not from imitation, but from developing your own map and compass, forged through independent analysis and critical thought. Are you building your own compass, or are you still searching for someone else to point the way? We have journeyed together, peeling back the layers of common financial myths, shining a light on the subtle ways they can erode not just our wealth, but our confidence and sense of mastery. As Warren Buffett wisely noted, with a gentle understanding of human nature, risk comes from not knowing what you're doing. The true antidote to these pervasive investment myths, then, is not more complexity, but a deeper understanding and a relentless commitment to critical thinking. We have seen the illusion of diversification, where simply owning more can often lead to less protection when hidden correlations emerge during times of stress. We've navigated the efficient market trap, discovering how widespread behavioral biases create predictable inefficiencies, offering opportunities for the disciplined mind. We've unmasked the illusion of passive income, recognizing that true sustainable wealth requires active diligence and a forensic understanding of underlying mechanics. We've distinguished between the impossible task of market timing and the powerful, learnable skill of strategic positioning, guided by macroeconomic analysis. And finally, we confronted the guru effect, understanding how blind trust in conventional wisdom can sabotage our financial autonomy, subtly silencing our own critical voice. The path forward road, then, is one of quiet strength and profound clarity. It is a path to enhanced financial literacy, where every decision is rooted in a data-driven truth, not in fleeting narratives. It is about sharpening your critical thinking, allowing you to deconstruct market noise and discern the genuine underlying mechanisms of wealth creation. This journey empowers you with the confidence to execute independent, informed investment decisions, free from the anxieties of conflicting information and the fear of costly mistakes. Now, we invite you to take a moment to let these truths settle within you. Imagine yourself standing at the edge of a vast, clear forest, no longer lost in the tangled undergrowth of misconception. You hold a map forged from data and a compass calibrated by critical thought. This is the moment to embrace data-driven analysis, to courageously challenge conventional wisdom, and to build sustainable wealth through mastery, not through myth. What fundamental truth will you commit to uncovering today to deepen your understanding and fortify your financial future?